Assalamualaikum and good afternoon, everyone. Welcome back. So for today, we are going to continue with topic number 9. Okay, topic number 9 is about capital market theory. Give me 1 second so that I can share with you the slide. Okay, the capital market theory. So capital market theory is basically nama pun theory. It's a theory related to analysis of investments, okay, especially related to the capital market. Okay, as you all know, capital market relates with instruments related to debts and also equity. Okay, especially equity lah. When we talk about equity, obviously we are talking about shares. Okay, and in this capital market theory, it will revolve around the concept of the risk and return. Okay, the risk and return. So therefore, we're gonna explore. Okay, actually, in the capital market theory, there's a lot of models, but for today, I'm gonna focus only on the important ones. Okay, at least for us, right? Anyway, so capital market theory extends the portfolio theory, which was developed by Markowitz, and in this capital market theory, they will try to develop a model for pricing of all risky assets. Okay, as you all know, majority of investments, okay, which is known as assets here, will have some element of risk. Okay, but in the capital market theory, they will define one kind of investment which is considered as risk-free assets in order to compare it against all the risky assets. Okay, the assets with the risk elements. Okay, so this concept tries to explain and predict the progression of the capital market using a few mathematical models. And as I said, there's a lot of models if you want to discuss in total capital market theory. But for us today, we are just focusing on one specific model, which is known as capital asset pricing model, or in short, CAPM. Okay, capital asset pricing model. In fact, we have a lot more. Okay, some of the models also part of my notes here. For example, arbitrage pricing theory, APT. Okay, but in terms of the discussion, I will talk only about KPM. Okay, for today, KPM. Right, and in fact, KPM pun, they have two separate models, and I will go specifically for one, just for one model under KPM. Anyway, but before we go into CAPM, we need to understand first what is capital market theory and what will be the assumptions, okay, revolve around the capital market theory. Okay, so these are a list of assumptions that we need to use in order to make this capital market theory works. Number one, we will assume that all investors, okay, under the Markowitz efficient frontier, okay, and every one of the investors want to be on this considered as efficient frontier. So meaning everyone will try to utilize or maximize their investment. Okay, there's no investors which just want to have a minimum returns, for example. Okay, so all investors are considered to be part of this efficient frontier. That's assumption number one. Right? Assumption number two, all investors can borrow or lend money at risk-free rate of return, or in short, RFR. Okay, risk-free rate of return. As I said earlier, majority of investments will have the element of risk. Okay, but even in Bank Negara or World Bank, okay, there's some of investment we can categorize it under risk-free. Risk-free, and this risk-free investment usually refers to government securities. Okay, government securities. So what does it mean by government securities? Investment or securities issued by any governments. Okay, for example, in our case, by the Malaysian government. Okay, so we have a lot of government securities, especially in Malaysia as well. For example, we have MGS. If you remember last semester, you've learned in banking and financial institutions, especially in the money market sections. Okay, in the money market sections, we have government securities. Okay, among others, we have MGS, Malaysian Government Securities. We have Bank Negara Malaysia bills. Okay, give me 1 second. Just give me 1 second. Okay, sorry about that. Mana tadi? Okay, yeah, sorry. So we talk about some investment which is considered as risk-free. Okay, as I said, any government securities, meaning securities issued by the government. So in our case, we have MGS, Bank Negara bills, or in general terms, usually we have also like treasury bills. Okay, or in short, we put it as T-bills. Okay, treasury bills is also considered as risk-free rate of return. Okay, so here in the capital market theory, we're going to assume that every investor will have this access. Okay, meaning they can borrow at these rates. Usually when we talk about government securities, these securities are guaranteed. When we talk about risk-free rate here, bermaksud, when we invest in this investment is guaranteed. Okay, we're not having any risk, meaning the government for sure will pay us the return without any possibilities of default. Okay, so that's why we put it as a risk-free investment. And this risk-free rate of return will have a minimum or a specific returns. Okay, for example, let's say the MGS is around, let's say, 3%. Okay, so this 3% will be our rates, okay, for the investors to borrow, or if they want to lend to other investors, they're going to lend it at 3%, for example, 3%. Okay, so this is the assumption number 2. Okay, there will be a minimum returns guaranteed based on this risk-free rate of return. The third assumption, all investors has a homogeneous expectation. So what does it mean by homogeneous? Similar, right? Similar or basically the same expectation. Okay, so even though in real world, obviously everyone will have different expectations. You and me, might have a different expectation with regards to our investment. But in capital market theory, the assumption would be everyone will have the same homogeneous expectations. Okay, or else we cannot make this capital market theory works. Okay, and the fourth one, all investors will have the same one period time horizon. So meaning if one investor have a 1 year period of investment, okay, we will assume everyone will have the same. Okay, for example, here 1 month, it can be 1 month, 6 months, or even 1 year. So again, in real life, obviously, different people will have different time horizon for investment. Okay, some people might have access of funds only for 1 month and try to maximize the returns within 1 month. But some maybe have a longer period to invest, okay, in real world. But in this capital market theory, we're going to assume everybody or every investors will have the same. Okay, that's another assumption for 4. We also assume that all investments can be diversified, okay, infinitely diversifiable, meaning we can diversify in a smaller fractions of the shares. Let's say if we have, I don't know, 100,000 ringgit, we can divide whatever we want. Okay, that's number 5. Okay, we're going to assume also there'll be no transaction and tax. Okay, there'll be no tax and also transaction costs involved when we buy or selling assets. Even though in real life, again, obviously there will be transaction and even tax. Even when you invest in the stock market, every time you purchase and you want to sell it, there will be transaction costs, and the profits that you earn will have tax applied to you, for example. All right, but in capital market theory, we're going to assume there'll be no tax and transaction costs. Okay, 4, 6, 7, yeah, number 7. We will assume also there'll be no inflation. Okay, obviously, again, if you look in the real world, we have inflation every day. Okay, we can measure it by looking at CPI. For example, in Malaysia, mostly we use CPI, Consumer Price Index, as our inflation indicators. Okay, but in CMT, capital market theory, we're going to assume there'll be no inflation because this inflation will affect the changes of interest rates. Okay, but for our assumption, there'll be no inflation involved. Okay, and lastly here, we're going to assume that the capital markets are in equilibrium. Meaning, because when we do economic assumptions or economic estimations, we're going to assume our model to be equilibrium, or else we cannot predict our estimation. So therefore, in this capital market theory, we're going to assume these capital markets are in equilibrium. Equilibrium meaning it's properly aligned. Okay, properly aligned in terms of the pricing, in terms of the risk as well. Okay, even though, like I said, in real world, sometimes some investment might not align in the equilibrium points, okay, in a short-term basis at least. But for the capital market theory, we're going to assume every assets will be in line with the risk. Okay. So in terms of the development of capital market theory, okay, the main important aspect of capital market theory is the concept of the risk-free asset earlier, as I mentioned. We're going to have one risk-free asset as our benchmark in terms of the returns. And we're going to compare these risk-free assets against the risky asset. Okay, we compare versus the risky assets. Okay, and for these risk-free assets, the characteristics of it is a type of asset with 0 standard deviation. Okay, if you remember in the topic of risk and return before, the measurement of risk, okay, the measurement of risk, one of them is standard deviation. As you all know, the other part would be variance, right? Okay, variance is another proxy for risk of investment, and the other one would be the standard deviation. So for this case, the risk-free asset will have 0 standard deviation, meaning it's 0 risk. Okay, hence the name risk-free just now. Okay, so that's one characteristics. And this risk-free asset will have no correlation. Okay, again, this you learned this before in the risk and return topic as well, whereby one of the measurement is the correlation between assets. Okay, so in this risk-free assets theory or concept of risk-free asset, this risk-free asset will have no relationship, okay, zero correlation with any other risky assets. If you remember, okay, when we talk about correlation, there are three possibilities. It's either positive relationship, negative relationship, or zero relationship. Okay, positive means the two assets move in the same directions, either goes up or go down. Okay, but for negative, it move in different directions. Okay, and the third category will be zero relationship or zero correlation. It means there's no relationship between the assets. Okay, and this risk-free asset, we have zero correlation. Okay, and this risk-free asset will give you risk-free rate of return, as I said tadi lah. Okay, very minimum rates. Okay, you can later on you can try to find can be 3%. You cannot remember lah. Can be 3%, 4%, depending on questions. Okay, and lastly here, this risk-free asset, if we put it on a graph, on a portfolio graph, okay, as you all know, the graph will have two axes. Okay, in capital market theory, the graph will be based on return on top. For the vertical line, we have returns, and on the horizontal line, we have the risk. Okay, the risk. Okay, and these risk-free assets will lie on the vertical line. Okay, for example, I'll put it here. Okay, this line. So this will be our risk-free rates assets. And it will start somewhere on top because we're gonna have a minimum return, as I said. We're not gonna get 0% return, so therefore it's not be here. So it'll be somewhere above. Let's say this is 3%. Okay, and it falls in this vertical axis because we have zero risk, okay, zero risk here with the minimum returns. So it's not here, but kalau kita letak kat sini, we have some element of risk. Okay, for risky asset, it will fall somewhere any on the line. Any on the line will be risky asset, but for this risk-free, it will fall on the vertical line exactly at zero, but with the minimum returns. Okay, it will not start from here. Okay, it will start somewhere above 0%. Okay, as low as 1% maybe. Okay, so that's the concept of risk-free assets. And this risk-free asset will be important because in our formula later on, we're going to use these risk-free assets as part of our calculations in order to determine. Okay. So in KPM, okay, now we're going to specific model under the capital market theory, the capital asset pricing model. I know in your notes you're gonna see us skip a few sections already right now. I skip the lending and borrowing theory. I go straight into capital asset pricing model or KPM. Okay, so this model will show the relationship between the expected returns and the expected risk. Okay, just like I showed you earlier. We have the return here and also risk here. But we're going to specify what kind of proxy or what kind of measurement for returns and also risk, because for risk we have a lot of measurements. Okay, among others, standard deviation, variance. We also can measure risk using beta, for example. Okay, so we're going to specify later on what kind of measurement will be used for risk and what kind of measurement can be used for return. Okay. So for expected returns, if you remember again from the concept of risk and return in topic number 3, if I'm not mistaken, 3 and 4, we have this, ER, expected return. So this actually will be used for the measurement of returns. Okay, for the measurement of returns. Okay, so if you remember earlier, if you want to calculate the ER, we have to calculate based on the probability of the outcome of the returns, and we find the average of it, okay, using the probabilities, okay, to find the ER. Okay, and for KPM, the expected risk will be measured using the expected risk. Okay, and this specifically they will focus on the systematic risk. Okay, again, if you remember earlier, at least earlier of the semester, we've discussed in terms of risk. We have two types of risk. We have systematic, and we also have non-systematic. So what's the difference between the two? Systematic risk cannot be diversified. Okay, can diversify. So what does it mean here? For non-systematic risk, we can reduce. Okay, we can reduce the risk by doing diversification. Okay, by doing diversification, meaning we do a portfolio of investment, for example, we can reduce the non-systematic risk. Okay, but for systematic risk, okay, how good we diversify, we cannot reduce this risk. Okay, so therefore this systematic risk cannot be reduced by diversification, and this systematic risk can be measured using beta. Okay, for non-systematic, as I said earlier, we can measure this using variance and standard deviation. Okay, we measured using these two before. So that's why when we do the portfolio, you can see the reductions of variance and standard deviation. Okay, but for systematic risk, somehow we cannot reduce the risk, because usually when we talk about systematic risk, this is something external, something outside of the firm, some external factors that cannot be controlled by investors. Okay, for example, political stability, okay, market situations, okay, economic situations. So all of those are part of systematic, right? So that's why for risk-free return, okay, for risk-free return, both systematic and non-systematic will be at 0%. There will be 0% risk for both. Okay, but for other types of investment, yeah, we can reduce the non-systematic until 0. Okay, but there will be some element of risk involved in the form of systematic. Okay, so the measurement of beta will be there for any types of risky investment or risky assets. Okay, so that's our measurement lah. So if you go back to here, so here for return, usually we're going to measure using ER, expected returns, and for the risk, we're going to use beta. Okay, beta. Right? Okay, so this one I think I've mentioned quite a few times already in terms of the systematic and the systemic risk versus the non-systemic risk. So the model will show the combination of the risk and return. Okay, I'm not going to talk about this one because under the KPAM, capital asset pricing model, we have two different models. Okay, we can talk about CML, capital market line, number one. And also we have the second one is known as security market line, or SML. Okay, and both have two different set of formulas, right? And as in terms of the graph, okay, illustrations, you're gonna see the model is more or less the same, but how we determine the model will be different based on the formula. So for this semester, okay, I'm gonna skip CML. I'm just gonna focus on SML. Okay, so if you're interested to know, you can read about CML. You have the formula here. You can try how to define the line, okay, and use this equation to generate the line, okay. But for us, okay, you're gonna see some similarities between CML and SML in terms of the content, okay. But obviously the difference will be the formula used. Okay, in terms of the construction will be the same as well, but like I said, we just focus on SML, security market model. Okay, so for SML, okay, the assumption would be for a well-diversified portfolio, we're going to assume that there will be no non-systematic risk. Okay, meaning the non-systematic risk will be go to 0. Okay, because we properly diversified, therefore the non-systematic will be at 0. So our standard deviation will be 0. However, the second part of the second part of risk, the systematic risk, will still be there. Okay, and this will be measured by beta. Okay, so the stocks or the portfolios will still have the beta attached together with the investment. Okay, so for SML, this is a special case of KPM, and it will measure the risk and return trade-off, as I said before. And in this model, later on, you're going to see that in order to generate the graphs or the model itself, we're going to create a line which is known as SML. Okay, we're going to create a line which is known as SML, security market line, and we're going to plot, okay, we're going to plot our investment or our portfolio in this graph to determine whether the investment is under or overvalued. Okay, under or overvalued. Okay, so first we're going to create this line. I'll show you afterwards how to create this line. So we need to first calculate every investment's SML, and then we're going to draw a line based on their results, and then you're going to compare each ER, expected returns, for each investment onto this SML, and you're going to find later on that the plots will lies is either above the line like this, or it can be below the line, or it can be exactly on the line. Okay, there are three possibilities. So if the plot of the ER of one stock is above the SML, like this, let's say I put it here A, this indicates that the stock of A is undervalued. Okay, undervalued. So if any investment lies above the SML, we consider them as undervalued. Okay, any investment above the line, it is known as undervalued. But for, let's say this is stock B, one below the SML, we're gonna label this stock B as overvalued. Okay, the concept of under and overvalued, I think you're done familiar. We've discussed this quite a lot in the stock valuation before. So when we talk about overvalued, obviously the price is overpriced, okay, expensive. If you want to recommend, obviously, if you want to buy, we don't recommend to buy overvalued. We recommend to buy undervalued assets, undervalued investment, right? And if you want to sell, yeah, obviously we will recommend to sell overvalued investment and do not sell undervalued investment. Okay, so the concept or the justification will still remain the same as before. And the third plot will be on the line itself, like here. Let's say I put it here, stock C. If it's exactly on the line, okay, we're gonna say that this stock C is fairly valued. Fairly, or stock C, fairly valued. Okay, so fairly valued means the price is exactly like what is currently being sold in the market. Okay, it's fairly priced. Okay, so that's how we use SML. Okay, I recap. We're gonna actually calculate first the SML. Okay, but I will show you afterwards what will be the elements of SML, the formula. And once you have the SML for every stocks, can plot on the graph to create a line. And once we have this line, we're going to compare against the expected returns for each investment. Okay, to compare whether it's under, over, or fairly priced, okay, or fairly valued. Okay, this one I already mentioned tadi lah. Okay, so here are the elements. Okay, but again, this is once completed lah. Okay, once completed, you're gonna have one SML line. And note it's not going to start from zero. It's going to start somewhere above 0%, let's say 3% here, with zero beta, zero risk. This is risk-free rate, risk-free rate. And we have another elements of return, our M here. M here refers to market, returns of market on average. And for market returns, okay, we're going to assume that the beta will be at 1.0 or at 1. Okay. And in equilibrium, all securities will be on this line, right? But as I said, we're going to compare what would be the expected returns for all securities or all investment, all portfolios, compare against the SML to determine whether it's under or overvalued, just like I tunjuk. So under KPM, investor is concerned only with the ER and beta, only these two elements. Okay, and this one I mentioned a few times already, so just go straight to the equation. Right, so just focus on this one. Okay, because for the market portfolio, technically the formula would be the same. Okay, so for the returns or the SML, RI also known as the SML, SML of the stocks, is equals to risk-free rate of return, okay, plus the beta of the assets, okay, the beta of the assets, multiply with the difference of market returns minus risk-free returns. Okay, so technically, if you go back to here, we want to find the difference between these two. Okay, obviously, our market return will be higher than risk-free rate. Okay, our market returns cannot be somewhere below this. The market return will always be higher than risk-free returns. Okay, that will be part of our KPM assumptions. Okay, we cannot get a negative values in these brackets. And the difference we multiply with the beta for each asset, right? And the output of this, we're going to add back with the risk-free returns. And that will be the SML for one asset, asset A, for example. Then you move on to asset B. Then you're going to recalculate back using beta for asset B. Okay, and as you all notice, these two sections is based on general terms. So for every assets, we're going to have the same information for the market returns and also for the risk-free rate. So the main difference would be the beta. Okay, or let's say you compare 5 assets. Okay, so out of these 5 assets, they might have different betas for every assets. But for market returns and risk-free returns, it will be the same. So therefore, the ones in the bracket and the one in front here will be consistent for all assets except for the beta for each. And that will determine the difference of SML for all 5 instruments. Okay, to make things complicated, because sometimes question doesn't provide you with the beta straight away. Okay, so if beta is not given in the question, okay, you might have to calculate your own beta. So to find beta, we're going to have to calculate using this formula. Okay, so the formula of beta is covariance. Okay, COV is covariance. Covariance of I and M. I here refers to the assets. M here refers to the market. So we want to see the covariance between the assets and the market. Okay, how they react, they behave between one and another. And we're going to divide with sigma squared ni simbol apa? Ingat tak sigma squared? Sigma squared. Is it variance or standard deviation?
Standard deviation.
Kalau you ingat standard deviation sebelum ni, kalau nak cari standard deviation, we have to square root variance. Okay, square root variance. Why we square root? Because variance yang sigma squared. So sigma squared ni is variance. Okay, variance of the market. Okay, variance of the market. Okay, so technically, kalau lupa ni covariance versus divide by variance of the market. So I recap, this is covariance between the stocks and the market, and we divide with variance of the market. Okay, not variance of the stocks, variance of the market. Okay, to make things even more complicated, all right, in order for you to find the beta, the question might give you, instead of variance, we need variance to calculate beta, right? They might give you standard deviation instead. They give you standard deviation. So how to find standard deviation? How to find variance? So you have to adjust this standard deviation into variance. Okay, you've learned this before. Similarly like covariance. Okay, if you remember, for covariance, we can derive from covariance, we can derive correlation. Okay, we can derive correlation as well. So if the question provide you correlation, you need to convert it into covariance. Okay, this one you need to go back to our earlier topics lah. Look for the notes and cari what is the formula for correlation. Okay, whereby we use the covariance. Okay, so you need to integrate your knowledge from the previous topics. Obviously, this is the high level punya topic already. So you need to integrate your knowledge from previous topics and apply it here. Okay, it's not something new. You've learned this before, but you need to integrate lah, like I said, the knowledge, because this is somehow related. Okay, using the previous formula into this beta calculations. Okay, but in general, the basic formula for beta is covariance divided by variance of market. Okay, if it's not given. Okay, so if you're lucky, the beta is already in the question, so you don't have to worry about others. Okay, but sometimes the beta is not given directly. You have to calculate yourself. Therefore, this is why we have this formula to help you to find the beta. Once you have beta, then you can use to calculate the SML. Okay, now, so what will this SML tells us? Okay, so obviously, they're going to create, like I said, a linear function, a straight line, and under the line, ataupun in this particular graphs too, they will give to you, okay, the risk-free rate. Risk-free rate will be somewhere there. Okay, they're gonna have a beta. Okay, for all securities and also for the market price as well. Okay, for the market as well. And this line ataupun this will have a linear function. When we talk about linear is a straight line. Okay, straight line function for the beta coefficient. And as I said, one of the main contribution of SML is the indication of whether the stock is undervalued or overvalued. Okay, or overvalued. So this is the main contribution. So we can determine by looking at the graph like this, or if we can look comparison between expected return versus the SML. Okay, if the expected return is above the SML, like this, all of this is the expected return of respective stocks. Okay, so if it's above the SML, okay, like this, ER is more than SML, this indicates the stock is undervalued. Okay, if ER is above SML, this is undervalued. Okay, ataupun underpriced. But if the ER is below the SML, this is overvalued or overpriced. This one. So how You can look from this graph as well. When the C stop here, the ER of the C stop is below the SML line, like this, it indicates overvalued. Okay, overvalued or overpriced. And the third possibility would be if ER is equals to SML. So if it's equal, it will be exactly on the line as I said before. So if that's the case, we call them as fairly priced. Okay, fairly or sometimes properly priced. Okay, they will lie along the SML. Okay, and that will be our task lah when we talk about SML. We're gonna calculate the SML, draw the graphs, indicates above or below the line, and also determine whether it's over or under price. Okay, over or undervalued as well. Okay, in summary, the same concept applies before. If it's undervalued like this is desirable to own, meaning we will recommend to buy. Okay, undervalued, gonna buy, or yeah, put it here lah, as a recap, undervalued. Recommendation is gonna buy or gonna hold. Meaning we don't, if we own it, we don't sell it yet. Okay, do not sell. Tapi kalau over, okay, do not buy or gonna sell it. Okay, try to sell. If you own the stocks, if it's overvalued, if it's overvalued. Right. So let's go straight to one example. Okay, so given the following data, we have 4 different portfolios, A, B, C, and D. So when we want to calculate SML, it's not necessarily for individual stocks. Yeah, we can also measure using the portfolio. As you all know, portfolio here consists of multiple investment inside this particular portfolio. So imagine we have 4 different portfolios labeled as A, B, C, and D with 4 different ERs, 4 different average returns ataupun expected returns. Okay, 7%, 4.5%, 5.2%, 8.5%. And together with the ER, they provide you with the beta as well. So once you've seen the beta in the question, automatically the rest of information is not required. Okay, standard deviation, for example, is not required. Okay, so this is just for your information. Okay, because if you remember, and in SML, we just concerned with ER and beta. Right? So besides this portfolio of A until D, the question also provide 2 more information for market and also T-bills. Okay, remember, in the formula, we need to know the return for the market, which is in this case is 7.5%, and we need to know the risk-free return. Okay, and in this case, they don't put risk-free rates. Instead, they use a proxy of treasury bills. Okay, I mentioned earlier, treasury bills is one of the indicator for risk-free returns. Okay, so this would be risk-free returns for T-bills ataupun in the form of T-bills. And again, if you remember for SML, the formula would be return for risk-free plus the beta of the stocks, okay, multiply with return of the market minus return of risk-free. Okay, we can calculate for all. Okay, for A, B, C, D, and even for the market if you want, because the market that we have data. Okay, for TBs, we don't have to calculate because the beta is 0, right? So technically, TBs will be 3.5%, exactly 3.5%. We don't have to calculate. Okay. Now, for portfolio A, for example, based on this formula, we know the beta is 0.8. Okay, 0.8. For example, if I put A here, find the SML for A. So the risk-free rate is 3.5%. Okay, we're going to plus with the beta of 0.8. Okay, and we multiply with the difference, 7.5 minus 3.5. Okay, so 7.5 minus 3.5 is 4%. So the difference is 4%. So 4% times 0.8 is 3.2. Okay, 3.2. 3.2 plus 3.5 is 6.7. Okay, so for portfolio A, the SML would be 6.7. Okay, 6.7 for portfolio A. Okay. For portfolio B, you're gonna switch the beta element only because 3.5 and 7.5 minus 3.5 will be the same for all A, B, C, and D. So the one that we're gonna exchange will be the beta only. So meaning for portfolio B, the beta will be 0.4. Okay, so meaning 4% times 0.4 plus 3.5 is gonna be 5.1. Okay, the SML will be 5.1. So 4 times 1. Okay, 5.1 for portfolio B. For portfolio C, okay, again, 4% times 0.5. Okay, the beta for portfolio C is 0.5 plus 3.5, 5.5. Okay, 5.5. And for portfolio D, 4 times 1.1 is 3.5. So we have 7.9. 7.9 for portfolio D. So this is our SML. And kindly note, SML and ER will be different, obviously, except if it's fairly priced, it will be the same. You get exactly the same. For example, if you try to calculate market, like say you want to calculate the market SML. So the beta is 1. So RM minus RF is 4. 4 times 1 is 4. 4 times 3.5 is 7.5 as well. So for market, the SML and the ER is exactly the same, 7.5. So this is basically fairly priced. Okay, anyway. So that's our first step, to calculate the SML. Okay, using this formula. Okay, this formula, I'm gonna use this formula. Okay, and as I said, for all portfolios, the items for risk-free and the market returns will be the same. The only difference would be the beta only. Okay, only for the beta. And we have this SML scores for all A, B, C, and D. Okay, and this can be expanded if you can see from here. Okay, I've expanded 3 more rows here. After the SML, we have 6.7, 5.1, 5.5, and 7.9 respectively. We can compare the relationship. Okay, I showed you earlier this part. I showed this comparison between the ER and SML. Okay, some might be higher, some might be lower, or it can be equivalent. So you need to compare this ER versus the SML. So for A, as you can see, the ER is higher than SML. So ER is higher than SML. Okay, 7 is higher than 6.7. So you compare for all 4. So for B, it's lesser. Okay, similarly for C, 5.2 is lesser than 5.5. But for D, again, the ER is higher than SML. Okay, please compare with the respective SML. You don't compare cross with other SMLs from different portfolio. You must compare within the same row here. Okay, 8.5 versus 7.9. So we have ER is higher than SML. And as I said, for the market, it's equal. So for above, again, I also mentioned tadi, the meaning or the status, if you want to know. For portfolio A is undervalued. B and C is overvalued because it's less than SML, meaning it will fall below the SML. And for portfolio D, it's undervalued again because the ER is higher than SML. So what can we do? What can we suggest? Action or suggestion? For undervalued, we're going to invest or we're going to buy. Or if you want to sell, we do not sell, we hold. the investment for time being because it's undervalued. Okay, similar to portfolio D, because both are undervalued. But what happened to portfolio B and C? Again, as I mentioned earlier, your recommendation would be do not buy, right? Or you're gonna sell it. Okay, if it's the selling position, you're gonna recommend for selling the portfolios because it's overvalued. Okay, so please use this template to answer SML questions. So for the first 3 line here, at least for this question, this is all from the question, from the table of this question. Just extend the SML based on the formula. Please show the calculation as well for all of the portfolios. Show the relationship, okay, indicates the status, and what would be the possible suggestion for all. Okay. Besides this, question might ask you to draw the graph, okay, or plot the graph. So the next page, you're going to see the graph, which is already completed. And by the way, this graph might not be accurate in terms of, because I don't use a proper tool to measure. This is slightly incorrect. Okay, but technically, if you want to prepare a graph like this, okay, first thing you need to do, okay, to determine the risk-free return. Okay, first thing you need to do to determine the risk-free return. So in this case, the risk-free return in the form of T-bills is 3.5%. Okay, yeah, 3.5%. And the question also gave us the market, which is 7.5%. So you can plot these two. Okay, and the market usually will have 1. Okay, supposedly it's around here, 1. Okay, let's say it's here, 1. 1, 7.5. And remember, our 7.5 is correctly valued, meaning it will be on the line. Okay, so that will be our starting point. Okay, imagine the rest we don't have yet. Okay, so we just have 1x and 2 plots of returns. This is risk-free, and this is market returns. Once you plotted these two, you're going to focus on SML first. Okay, we're going to put axis on the SML. Right, so we're going to go one by one. We're going to start with portfolio A first. Okay, portfolio A, and look for the beta. Beta is 0.8 and the SML is 6.7. So 0.8 is here. I'm going to plot 0.8 here, katakan. And we're going to go up until 6.7. So might be not really accurate, but it should be below than 7.5. Okay, imagine this is 6.8 lah, imagine. Okay, this is for stock A or portfolio A. Okay, for portfolio B, the beta is 0.4 and the SML is 5.1. Okay, 0.4, and imagine be here. Let's say lah, this is 5.1. Okay, 0.4. Okay, and for for the next one, C is 0.5. The SML is 5.5, so 0.5, slightly above 5.5. Okay, maybe not really accurate, but anyway, C maybe not here. Okay, I'm gonna move C later. And last one is 1.1 with 7.9. So 1.1 is here. So it's slightly above 7.5, which is at 7.9 here. See. So once you have this axis, okay, then you need to draw one line from 3.5, follow through all 5 axes. So in this case, you can see the line already lah. But imagine if you don't have the line, so that's how you draw that line. Go cross all 5 axes. Okay, and that would be your SML. Okay, so that's your next step. First, risk-free rates with the market return, and then indicate with 1, then 4 axes based on each portfolios, and then create one line. So once you have this line, then we can plot the respective ER of all stocks. Okay, again, we're going to use the beta as indicators. So for portfolio A, 0.8 kan, beta dia. 0.8 beta. We know this line is 6.7 just now. So for ER of stock A, it's at 7. Okay, it's above the line. So maybe this is too high, maybe. It's supposed to be slightly here. Okay, but still above the line. Okay, for stock B, it's 4.5. Okay, below 5.1. Sorry, beta dia apa? 0.4, 0.4. So it's supposed to be here, yeah. So the B is okay. It's below 5.1. For C, 0.5 is 5.2. Again, it's below the line. So C is supposed to be here, Imagine it's about here. And finally, D is 8.5 above the 7.9. So this is 7.9 points. So 8.5 is somewhere above there. Okay, 8.5 is above there. Okay, and that will be how we plot the SML. We're going to show the risk-free returns, the market returns, the SML line, and also the plot of ER for all 4 stocks of all 4 portfolios. Okay, must be applicable or must be shown on the graph with the correct positioning. Okay, A and D is above the line, B and C is below the line. Okay, then you're going to get the full marks for construction of SML. Okay, so that's SML as a whole, right? So as a recap for SML, okay, for this question, they already provide you with beta, so you don't have to worry about the beta calculations. So we're going to use the beta straight away in our SML formula to find each SMLs. And once you have that SML, okay, you can compare in terms of the relationship, the status, and what would be the possible suggestions to do with that particular portfolio of stocks. And if the question asks you to prepare the graphs, you have to go through just like what I've mentioned to you earlier. Okay. Any questions? Right, so if there's no questions, let's take 5 minutes break. Okay, 5 minutes break. And after the break, I would like you to try this exercise. Exercise question number 1 here. Okay, so you're going to see some similarity and some difference also with regards to this question as compared to the one in the notes. So, for example, they use treasury bills also here, okay, with a different rate. So, you're going to have treasury bills. They have the market returns, and the question provide the standard deviation. And instead of portfolio, we're going to measure 4 different stocks. 4 different stocks in the form of mega, giant, super, and extreme. Okay, they use or they provide you with ER, but now you can notice that there's no beta. Instead, they give you covariance. Okay, covariance with the market. And if you go further, you're going to see the very first question, they ask you to find the beta. So therefore, you know the beta is not given. Instead, you're going to calculate the beta first. Okay, so please calculate the betas. Then calculate the ER based on the SML. Compare the ER with the SML. And they want you to plot it. So meaning you have to draw the SML. And identify the undervalued, overvalued, or fairly valued, meaning use the relationship, the status, and also the suggestion. And specifically, the question number 3, they ask you if the investor wishes to invest in either the stock of mega or super, justify your suggestion. Which one you should invest, mega or super? And obviously you need to determine first lah whether the stock is under or overvalued before you can suggest. Okay, but please take 5 minutes break. I'm going to leave this question shared on your screen. Okay, after the break, please try this maybe around, I give you around 15-20 minutes to try, and then we can compare the results later. Okay. Okay, how so far? How's everyone's doing? Okay, can you share the betas first? Beta. One point two, 0.7, 1.2, 0.8. Okay, betul. As you all noticed earlier, formula for beta is covariance, I and M. The covariance between the stocks and the market, which is this one. And we need to divide with variance of the market. Okay, variance of the market. The question provides us with the standard deviation of the market, which is 10%. And as you all know, to find the variance, okay, to find the variance, you need to square root the standard deviation. Okay, kalau standard deviation tadi, we square root lah, square. Kalau standard deviation, we square root the variance. But for variance, we need to square the standard deviation. Sorry, square. So since our standard deviation is 10%, so 10 squared is 100. Okay, so meaning we need to divide all of these by 100. Therefore, we get all of these betas. Okay, so moving on. Once you have the beta, next we can calculate the SML. The SML earlier, if you remember, yeah. So dah ada yang buat tu, thank you. So 8.2, 6.45, 8.2 also. And the last one is 6.8. Okay, using this formula, SML will be risk-free return ataupun risk-free rate plus beta of the stocks multiply with market minus risk-free. Okay, so our risk-free is 4% and our market is 7.5%. Okay, so for example, for mega, it would be 4% plus beta of 1.2, the difference of 7.5 minus 4. Okay, this is for mega. So 3.5, dia dapat 8.2. And this is also similar with super because they share the same beta, which is 1.2. Okay, so mega and super have the same beta, 1.2. Okay, by the way, when you talk about beta, the higher the beta, the higher the risk. Okay, the higher the beta, the higher the risk. Okay, so meaning from mega and super, they share the same level of risk, 1.2. So that's why in number 3, they ask you to compare mega and super. So it's very straightforward actually because they have shared the same beta. But anyway, you need to calculate to show all the calculations to get 8.2, 6.45, and 8.2 again, and 6.8 separately in order to show this SML figure. So once you have this, okay, SML, yeah, maybe I should use whiteboard here. So I'm going to rewrite balik lah, stock R just put the beta here and the SML. Next, you're going to have the relationship. Status. The action, last one. So you're going to have few things to show. So for stock, have mega tadi. Client. Super. Okay, so all these are from the question. So 13%, 6%, 7.5, and 10.6. Okay, and the beta we've calculated is 1.2, 0.7, 0.2, and 0.8. Okay, and SML, so far we have 8.2, 6.45, 8.2, and also 6.8. Okay, and in terms of the relationship, simply compare ER versus SML. So for Mega, it's more than SML. Okay, because 13 is higher than 8.2. For Giant, for ER, is less. SML. Super, yeah, similar. ER, less than SML. For Extreme, more than SML. So in terms of the status, this is undervalued. Okay, this is over. This is over. This is also undervalued. In terms of the action, obviously, buy Bye. Last one. Bye. Okay, so that's basically question number 1 and question number 2. Okay, calculate the betas and except plotting. Okay, I'm going to show you how to plot afterwards by using SML. Identify undervalued. Okay, every stock we already identify which one is under or overvalued. Right, in terms of plotting, okay, again, hopefully try to plot. So we have ER here, we have beta here. Okay, our lowest was 4% just now, which is the risk-free return. And our market return is 7.5. See. Okay, and our middle, let's say, is 1.0 here. So our first X, the middle one. So we know the line will be goes towards this line later on. Okay, so for Mega, the beta is 1.2. So let's say 1.2 is here. And the SML is 8.2. So 8.2 will be above, let's say here. So I put it here, 8.2. Okay. Trajectory dia maybe slightly off lah. I don't have ruler kat sini. So 8.2 for both, for Mega and also Super, they share 8.2 together. And for Giant, it's 0.7. So let's say kat sini 0.7. And it's 6.45, slightly below here. And for 0.8, let's say it's here. Okay, so yeah, again, like I said, I don't have a ruler. Maybe I need to readjust sikit kat sini. Something like that lah. We're supposed to have a 1 SML kat sini. This a bit. Just to make sure dia ada kat sini. Okay, something like that. SML. So once you have this line, take the ER for respective Mega, Giant, S, Super, and also Extreme. So for Mega and Super, it will both in this beta range of 1.2. So 1 is above, which is Mega. 13 is way above 8.2, right? So let's say it's in top here, M, as for Mega. And for Super, it's 7.5. Okay, this will be here. Right? And for Giant, it's 0.7. So Giant be slightly below. It's above 4% actually, yeah. PR is 6%. So because this line is supposed to be 6.45 again, Giant, let's say it's somewhere down there. Super already plotted here. And lastly, Extreme. Extreme is at 0.8 and the rate is 10.6. So maybe around here. Extreme. Okay, so if you ask me, since the question asked is between Mega and Super, right? For question number 3. Okay, so uh, we're gonna suggest, okay, to suggest that let's should best Mega stock. because stock is undervalued. Okay, because the stock between Mega and Super, yeah. So Mega is undervalued, Super is overvalued. So therefore, we're going to suggest so that investor will invest in Mega stock because currently the stock is undervalued. Okay, but let's say if the question asks us to compare between Mega and Extreme, okay, if we compare between Mega and Extreme, okay, for me, if they ask me to suggest, I'm going to suggest Extreme. Okay, so in terms of the best, we split the quadrant. If we split the quadrant, the top left would be the best investment. The top left quadrant. Let's say lah, kalau I split the quadrant macam tu Okay, katakanlah I put the quadrant something like this. The bottom left ni will be the best. Sorry, bottom left. Top left will be the best. Meaning low risk, high return. Okay, this is beta risk and this is return. So in this section, this is low risk, high return. So yang kat sini, the second quadrant will be high risk, high return. Okay, yang worst obviously the left, bottom left lah. Bottom left means low risk, low return. Okay, kalau kat sini lagi worst kot, high risk, low return. Okay, so therefore, if we have to compare between Extreme and Mega, then we're going to suggest Extreme because the risk is lower because the beta is only 0.8 as compared to 1.2, even though the risk the return is smaller, right? But in terms of the probability, the chances, the risk, obviously better for Extreme. Okay, but since the question asked between Mega and Super, so we're going to suggest the investor to invest in Mega. All right, so that's how you try to solve the SML question. So thank you. You can share the answer to Rowena. Thank you very much. So that's about it for capital market theory. I'm gonna put one quiz again, another quiz. Right, I will post the question tomorrow. Okay, tomorrow, the afternoon or evening, you check. And I'm gonna give you until the weekend, until Sunday, okay, to answer the quiz for the SML. Okay, so please check your My Guru later, okay, for the question, and I'll give you until this Sunday. Again, evening juga lah, maybe around 6. Sunday berapa bulan? Sunday 22nd. Okay, I will post the question tomorrow, 20th, and you will have until, sorry, not 22nd, 23rd. Okay, 23rd on Sunday, 6 p.m. Okay, so please check your My Guru starting tomorrow afternoon or evening. And you have until Sunday, 6 p.m. to submit your answer. So please do it within that time range, okay, for the next quiz, okay, relating to SML. All right, so I think that's about it for this topic. Thank you very much. So we have actually 2 more topics here. We have topic number 10, which is portfolio selection. So this is another topic which is quite crucial in terms of how we do the selections. Okay, we have a lot of analysis done. So now is the time for us to choose which will be part of our portfolio. So we're going to have 2 types of tools that can be used later on. You check lah, topic number 10. I've uploaded the question and also the exercise as well, My Guru. And then the final topic will be about the performance measurement. Okay, 2 topics to go, but now it's actually we only in week 10. So expect that we're gonna finish our semester early for this portfolio paper lah. And if there's any question, nanti just let me know. So even we have, in terms of the games, we have 2 more weeks to go this week. And this week and next week. Okay. No, next week. So yeah, still time to catch up in terms of performing the profits. Yeah, the profits is based on weekly basis. So meaning it's not based on the original 20,000. So let's say if you lose money in first week, but the second week you rebound, get higher returns, meaning your total value of your game is higher, then it's still consider profit for you for the second week onwards. So don't stop transactions, but be careful. I'm not sure whether this good or not. I've set 100 transactions. 100 transaction 2 is the maximum for the game. Okay, so you have a lot of transactions actually, 100. Even normal investors one don't have, don't invest that much in terms of number of transactions, 100 for 4 weeks. So for 4 weeks, technically for every week, you can transact 25 times. Okay, so don't spend every transaction too early. So meaning you left with nothing in the final 2 weeks to go. So please spare some transaction for the third and final weeks. Okay, so I think that's about it. So thank you again. And inshallah, I'll see you guys next week for the next topic number 10. Right? Thank you.
Thank you, sir.
You're welcome.
Thank you, sir.
All right. Welcome.